Imagine a bustling factory floor, machines humming, workers diligently assembling the latest gadgets. This is the heart of American energy production, pumping out millions of barrels of oil every day. Now imagine their biggest customer, a giant of the global economy, suddenly slashing their order by 90%. This is the stark reality facing the US as China, the world's largest oil importer, drastically reduces its reliance on American crude. The implications are vast, rippling through the global energy market and sending shockwaves across geopolitical landscapes. This isn't just about lost business, it's about strategic leverage in an increasingly competitive world. Oil, the lifeblood of the global economy, has become a pawn in a high-stakes game of economic chess between the US and China. As the two superpowers jostle for dominance, energy security emerges as a key battleground. China's move to diversify its oil imports away from the US is a bold declaration of its intent to chart its own course and lessen its dependence on a geopolitical rival. The ramifications of this decision extend far beyond balance sheets and boardrooms. The livelihoods of millions of workers in the American energy sector hang in the balance. Global oil prices fluctuate wildly, impacting consumers and businesses alike. And the geopolitical landscape undergoes a seismic shift as alliances are tested and new partnerships forged in the quest for energy security. This is not just an economic story, it's a story about power, influence, and the future of the global order. It's a story that will shape the lives of billions for decades to come. China's decision to slash its US oil imports by a staggering 90% is a calculated move with far-reaching consequences. This drastic reduction, a direct response to escalating trade tensions with the United States, sends a clear message. China is willing to leverage its economic might to achieve its geopolitical goals. The impact on the US energy sector is undeniable, as a major source of revenue dries up, leaving producers scrambling to find new markets for their surplus oil. The financial repercussions are immediate and substantial. American oil companies already grappling with fluctuating prices and increasing competition face a significant loss of revenue. Jobs in the energy sector, once considered secure and well-paying, are now at risk as companies adjust to the new reality of reduced demand. The ripple effects extend beyond the oil fields, impacting industries that rely on a healthy energy sector, such as manufacturing and transportation. This bold move by China is a stark reminder of the interconnectedness of the global economy. Decisions made in Beijing reverberate across continents, impacting businesses and individuals thousands of miles away. The era of globalization, with its promise of interconnectedness and shared prosperity, is giving way to a new era of economic nationalism, where nations prioritize their own interests, even at the expense of global stability. China's decision is a calculated gamble, a high-stakes wager that the benefits of reduced reliance on the US outweigh the economic costs. Only time will tell if this gamble pays off, but one thing is certain: the global energy landscape has been irrevocably altered. The current standoff over oil imports is the latest chapter in a long and contentious trade war between the US and China. The seeds of this conflict were sown years ago, fueled by a complex web of economic anxieties, geopolitical rivalries, and ideological differences. At the heart of the dispute lies a fundamental disagreement over the rules of the global trading system, with each side accusing the other of unfair practices and protectionist policies. The trade war escalated significantly in 2022, with the imposition of tit-for-tat tariffs on billions of dollars worth of goods. These tariffs, designed to protect domestic industries and punish perceived unfair trade practices, have had a significant impact on both economies. Consumers face higher prices for everyday goods, while businesses grapple with increased costs and supply chain disruptions. Oil, a strategically vital commodity, has become a key weapon in this economic conflict. China's decision to target US oil imports is a strategic move aimed at inflicting maximum economic pain while simultaneously reducing its dependence on a geopolitical rival. The US, for its part, has responded with tariffs on Chinese goods in efforts to bolster its own energy independence. The ongoing trade war is a stark illustration of the challenges of managing relations between two economic superpowers with vastly different political systems and worldviews. The stakes are high, with the potential for lasting damage to the global economy and a fracturing of the international trading system. Section 4, New Friends, New Pipelines, China's Energy Pivot. Faced with dwindling oil imports from the US, China has embarked on an ambitious plan to diversify its energy sources and secure its energy future. This pivot away from American crude has led China to forge new partnerships and strengthen existing ones with energy-rich nations eager to fill the void. Canada and Russia, with their vast reserves of oil and natural gas, have emerged as key players in China's quest for energy security. Canada, with its stable political system and commitment to free trade, represents an attractive alternative to the US. The country boasts the world's third-largest proven oil reserves, primarily in the form of oil sands, and is a major producer of natural gas. China has been steadily increasing its investments in Canadian energy projects, securing access to a reliable and politically palatable source of oil. Russia, a long-standing ally of China, has also benefited from China's energy diversification strategy. The two countries share a long border and a history of cooperation in the energy sector. Russia is the world's largest exporter of natural gas and a major oil producer, making it an ideal partner for China as it seeks to reduce its reliance on the US. This shift in global energy flows has profound geopolitical implications. China's pivot towards Canada and Russia strengthens its ties with these countries while simultaneously weakening the U.S. influence in key regions. The emerging energy map reflects a world increasingly defined by shifting alliances and a multipolar balance of power. Section 5. Shaking the shale. American energy feels the pinch. The impact of China's reduced oil imports is felt most acutely in the U.S. energy sector, particularly in the shale oil industry. The shale revolution, which transformed the U.S. into a global energy powerhouse, is now facing its biggest test yet. With one of its largest customers drastically cutting back on purchases, the American shale industry is grappling with oversupply, plummeting prices, and an uncertain future. The shale boom, fueled by technological advancements in hydraulic fracturing and horizontal drilling, unlocked vast reserves of oil and natural gas previously considered uneconomical to extract. This surge in production propelled the U.S. to the forefront of the global energy market, creating jobs, boosting the economy, and reducing reliance on foreign oil. However, the shale industry's dependence on high prices and consistent demand makes it particularly vulnerable to market fluctuations and geopolitical shocks. China's decision to slash imports has exacerbated an existing oversupply in the global oil market, driving down prices and squeezing profit margins for American producers.